In the next 5 minutes, I'm going to make you an expert about the death benefit options when it comes to life insurance, whether it be level death benefit, increasing death benefit, does life insurance steal my money when I die, all these things, all this confusion, you will become an expert, okay? So let's jump right in. So when it comes to life insurance goes off of what's called a per unit. So $1,000 of life insurance coverage is 1 unit. Okay, so when you hear 1 unit, that's $1,000 of life insurance coverage. Then there's a per unit charge. So we go per unit charge. And that is, let's say it's 50 cents, okay, to make the numbers even. So that's 50 cents per year. So that means if you bought a life insurance policy for $1,000 of coverage, you would be charged 50 cents per year. If you bought $2,000 of coverage, you'd be charged $1 per year, right? So it's pretty simple math. $1,000 of coverage equals X amount of dollars you have to pay to the insurance company, okay? Now, when we look at this, there's going to be a couple different categories. So we're going to have a cash value category. We're going to have a death benefit category. That's the death benefit you're purchasing. And there's also a net death benefit. That's what's going to pay out to your beneficiary upon your passing. Okay, so this is an increasing. Let's do increasing. So let's do an increasing option first. So you open your policy and we're going to say your death benefit is going to be $100,000. Okay, $100,000. We know the per unit charge. So that means mathematically we're buying 100 units. Okay, because if 1 unit is $1,000, 1 unit is $1,000 of coverage. 100,000 means that's times 100. So we're buying 100 units of coverage. So mathematically, I would take my 50 cent, 0.50 times 100. That equals $50 for my life insurance policy. So I got $100,000. It'd be $50 per year. Okay, so now when we look at this, you open up your policy. You have no cash value out the gate. Month one doesn't start off with cash value. Net death benefit is pretty straightforward. $100,000 will pay out. So if I open a policy on Monday and I died on Tuesday, my beneficiary will receive a check for $100,000. Okay. Now, let's say my cash value grew to $25,000. My death benefit I'm paying for is $100,000 because I'm paying that $50 a year. So my net death benefit will be $125,000. So it is increasing. My death benefit increases by the value of my cash value. So if my cash value grew to $50,000, I still have the $100,000 is here. That doesn't change. Now my net death benefit is $150,000. So it's pretty straightforward. It doesn't, make a difference. So my cash value could be $310,000. My death benefit is still $100,000. Now my net would be $410,000, which would pay out to my beneficiary income tax free. So that's an increasing death benefit. So obviously you can see you do get your cash value plus your death benefit paying out to your beneficiary. Okay, so now let's look at level death benefit, right? So we're going to switch this to level. So how does the level death benefit work? So we're going to use the cash value. We're going to have that same death benefit. And we have the net death benefit here. So with this situation, it's a little different because now this $100,000, we want that $100,000 to stay level, meaning I want my death benefit to be $100,000 no matter what. So I'm choosing a level death benefit that does not increase but stays the same. So we're going to keep that at $100,000 here. So right out the gate, I have no cash value. I buy the policy Monday, I die on Tuesday, my family receives $100,000 death benefit. Now, what happens when my cash value starts to grow? So let's say I have $25,000 in cash value. Okay, so now one thing that doesn't change is my net death benefit will always be $100,000. So if I have $25,000 in cash value and I die and my family is going to receive $100,000, it's easy to say like, well, what happened to my cash value? The insurance company stole that $25,000 because I had $100,000 death benefit, $25,000 cash value. But if 100,000 pays out, my 25,000 vanished. They stole my money. So here's how it really works. So with level, since you're just agreeing to a $100,000 death benefit, the insurance company is only going to charge you for the difference, meaning they're going to use your 25,000 as part of your own death benefit, meaning you self-insure. So they're going to charge you for the 75,000 that they're on the hook for. So they're responsible for the 75,000. You came up with 25,000. They're responsible for the 75,000. So why would somebody want to do that? Because remember, it's a per unit charge. So I take that 50 cent times 75 because I'm only purchasing 75 units of insurance from the company now. So that's going to be, instead of $50, now I'm only charged $37.50 per year because I'm buying less life insurance because I'm using my cash value as part of my death benefit. So what happens when my cash value grows to $75,000, right? My payout, I want my payout to still be $100,000, but guess what? Now I'm only purchasing $25,000 from the insurance company. So now they got to reallocate. So now we take that 0.50, my 50 cent times 25 units. Now my cost is $12.50 per year. So as my cash value grows, the net amount of risk lowers, meaning my cost lowers. And eventually get to the point where they can become even, but it could get as large. Let's say it's 90,000. 90,000, I'm only purchasing $10,000 of life insurance to have my $100,000 pays out. So I take my 50 cent times 10 units. Now I'm paying $5 a year for my $10,000 of coverage because I only need that to be level at 100,000. Now it's important to understand that if you were to take your cash value out, meaning let's say I borrowed that entire 90,000 out, then yes, my net death benefit will be $10,000 because I'm only paying for $10,000. So it's all about what's best for you. There's no one size fits all. Some people, it makes more sense to do level with, the cost decreasing because you either have to decide, I want a larger death benefit to pay out, and I'm willing to pay that death benefit cost through the remainder of my life, or I want my cash value to be as high as possible. So I want to squeeze my death benefit as low as possible to keep the cost low so my policy can be as efficient as possible. So each strategy can win depending on your scenario, your age, health and things like that. Sometimes there's a blend of both, but I just want to get you clear on the difference between the two types because in no scenario is the insurance company stealing your cash value, even at this point, because that 90,000 is the vast majority of what's paying out. But remember, you're only being charged 10,000 because that's what you agreed to pay for. And you as a client can choose if you want increasing or if you want death benefit before you move forward. So make sure you have an experienced agent. If you guys need help, there's a link in the description box. Reach out. Otherwise, ask a question in the comment section. If you don't have a question, drop a happy face so that YouTube knows this is a decent video. Of course, if you received any value, and I will see you in the next video.